This is an update to Valspresso's progress as of April 2020, covering a period of dramatic market volatility that was triggered by the COVID-19 pandemic. We will present how our model performed, and in summary, the answer is perfectly as expected. In just 6 days, the global stock market wiped out $6 trillion in value. By day 22, long-standing records were broken, with the fastest 30% sell-off ever, even exceeding that of the Great Depression. For most investors, recommendations were at this point simply too late. Things were moving too quickly. To briefly review Valspresso's technology, it is a mathematical engine that analyzes daily published financial data in combination with current interest rates and stock prices to partition each stock price into a fundamental portion and a portion that can be attributed to market sentiment. A patent on this model was granted on June 21, 2011. These daily indicators can be used to predict risk for each individual equity. Valspresso offers this data feed through our distribution partner, OpenFactSet, giving us direct access to their 5,000 global institutional clients and 100,000 users. For this demonstration, we are using MyAPM, our automated portfolio management tool that can be used to simulate and analyze varying strategies, or it can be used to manage portfolios in real time in an automated and dispassionate way. We will release this as a separate product once our data feed has established validity in the market. Let's examine our results. MyAPM provides a rich ensemble of parameters that one can set for each portfolio design. Independent designs can be saved and recalled. Parameters include market cap limitations, holding periods, stop-loss limits, and others. In this run, we limited our selection to the S&P 500 and started on January 2, 2004 with a $100,000 investment. The first day begins with 83 buys. Each day, the simulator takes all of the published data and calculates overnight the recommended buys and sells for the next day. The green area represents the cumulative return of Valspresso's tactical allocation strategy. The black line represents the cumulative return of the S&P 500. Note that during times when there is increased downside risk for an individual equity, or as in 2008 and again in 2020 for many equities, the algorithm automatically moves between equities, as shown in blue, and cash, as shown in yellow. Let's zoom in on the most recent activity, noting that the system started to aggressively move into cash on February 24th, and by the end of the simulation, 83.3% of the portfolio was in cash. At the close of the simulation, we can examine the overall performance in comparison to the S&P 500 and observe that the automated strategy consistently delivered better returns with lower risk. My strategy, in this case, beat the S&P 500 annual return by 1.5%, with a standard deviation that is 3.5% lower. My strategy's beta is 0.77, and its annualized alpha is 2.45%. Note as well the improvements to maximum drawdown, peak-to-valley durations, and recovery times. Also note that our portfolio has on average around 15% cash, further reducing its risk exposure. It is interesting to observe that the recent downturn in the market was actually well within the expected parameters of overall market performance. Understanding downside risk is essential to portfolio management. An analysis of the daily return series for the S&P 500 since 1950 shows an asymmetric market risk exposure. The black bars are a daily price series that are riskier than a normal distribution shown by the blue curve, and the negative skew suggests a larger downside risk. If we limit the analysis to the end of 2019, the probability of losing 2% or more on any one day is around 2.16%, with a maximum loss of 20%. But an analysis extended to 3/31/2020 has the same risk. This event was expected. If we expand the tail, the risk of losing 5% or more over any rolling 20 days is 7.65%, with a maximum loss of 29.5%. This means that, for example, a large public pension fund like CalPERS with $404 billion of AUM, including approximately $100 billion of U.S. equities, could lose up to $20 billion in any one day and up to $27 billion over any 5 days. This risk became a reality on March 22nd, with a loss of over 17% in 20 days, and this can and will happen again. The Valspresso technology is critically needed to mitigate the downside risk that is inherently part of the market. Regardless of your investment strategy, our indicators are designed to give you better investment outcomes by reducing risk. For more information, please contact us as shown. Thank you.